let's talk about one of the easiest places to lose marks in your direct tax paper. Seriously, it's a topic that looks so simple on the surface, but it has this one trap that catches so many students. We're talking, of course, about Chapter VIA deductions. And to show you exactly what I mean, let's kick things off with a question you could easily see in your exam. Okay, take a look. Your gross total income, or GTI, is 80,000, but your eligible deductions add up to 1 lakh. So what's the final total income? Just take a second and really think about it. Now, your gut instinct, your logical brain, is probably screaming to just subtract one from the other, right? But I'm telling you, be very, very careful. This is exactly the kind of question ICAI loves to use to see if you really know your stuff. So if you chose a loss of 20,000, hey, don't feel bad. That is by far the most common wrong answer, but it is a trap. The correct answer is actually nil. And if you stick with me for just the next few minutes, I'm gonna break down exactly why so you can spot this trap a mile away and never fall for it again. So why do so many students get this wrong? Well, it all boils down to a really basic, fundamental misunderstanding of what a deduction actually is in the Income Tax Act, and how it's totally different from an exemption. Nailing this one distinction is where you secure those easy marks. Okay, here's the core difference, and this is crucial. Think of an exemption under Section 10 as income that's basically invisible. It's like it wears an invisibility cloak. It never even shows up in your gross total income. But a deduction from Chapter VIA? Oh, that's completely different. That income is fully visible. It gets included in your GTI first, you calculate your total, and only then do you get to reduce that total. It's this two-step process that matters, because that second step, well, it's got a very strict rule. So just remember, exemptions are excluded from the get-go. Deductions are reduced from the final tally. With that clear, let's build on it. First things first, we need our starting line, and that is the gross total income, the GTI. This is just the grand total of your income from all 5 heads, you know the ones: salary, house property, PGBP, capital gains, and other sources. Think of this GTI figure as the absolute maximum amount you can ever claim as a deduction under Chapter VIA. And that brings us to the master rule. All right, let's talk about the section that runs the whole show, Section 80A. You can think of this section as the captain of the ship. Every single other deduction in this chapter, from 80C all the way to 80U, has to obey the commands laid out right here in 80A. And here are the 2 commands that matter most. Subsection 1 is simple. It just says you can take these deductions from your GTI. Easy enough. But subsection 2, this is the game changer. It says the grand total of all your deductions can never, and I mean ever, be more than your GTI. Your GTI is like a hard ceiling. You can get right up to it, but you cannot go a single rupee past it. This is the single most important rule for any MCQ you get on this topic. So let's circle back to our original problem. Our GTI was 80,000, right? Our eligible deduction was 1 lakh, but Section 80A2 steps in and puts up that hard ceiling. So even though we're eligible for the full lakh, the law restricts our actual deduction to the amount of our GTI, which is 80,000. So what's 80,000 minus the now restricted 80,000? It's a total income of nil, not negative 20,000. And here it is, your big exam tip. Write this down. Your total income can absolutely be 0. That's totally fine. But it can never, ever become negative because of these Chapter 6A deductions. Think of deductions as a shield to protect your income. But they can't be used as a sword to create a loss that you then carry forward. That's not allowed. And trust me, ICAI loves testing this exact point. Okay, so you've mastered the how much part of the deduction, but ICAI has another trick up its sleeve. It's not just about the amount, it's about when you file your return. This is Section 80AC, and honestly, this is where students can lose marks on a pure technicality. Now, you gotta pay really close attention to this one. For some of the big income-based deductions, think ADIA, ADIB, and so on, there's a strict all-or-nothing rule. You have to file your tax return on or before the original due date. If you're even 1 day late, if you file a belated return, your deduction doesn't just get reduced. It becomes 0. It's completely denied. A simple deadline mistake could cost you the entire claim.
So, take a look at the question on your screen. This is a classic. An employee puts 1,50,000 rupees into their PPF account and another 50,000 into NPS. Seems simple enough, right? What's the total deduction they can claim? Go on, take a second. Lock that answer in your head. You got it? All right.
Now, if your brain immediately went,
Easy, 150 plus 50 equals 2 lakh. That I've got some news for you. You've just walked straight into the trap. Now you might be thinking, but the number is 2 lakh. And you might even be right about the final number. But the logic, the method to get there is totally flawed. And that, my friends, is where you lose all the marks. So what is the correct answer? And more importantly, the correct way to calculate?
Welcome to what I like to call the 2-lakh deduction trap. See, the secret to cracking this nut isn't just about memorizing section numbers. It's about understanding how these sections actually interact with each other. It's not a simple addition problem. It's more like filling up buckets. Let me show you exactly what I mean.
Here's the core idea you absolutely need to grasp. Several different deduction sections that look totally separate on paper all flow into one single master limit. Think of it like a bunch of pipes, all leading to one big container that has a strict capacity. Getting this one concept right is the key to unlocking this entire topic.
And here it is. This is the master bucket I was talking about. It's called Section 80 CCE and its total capacity is 1,50,000 rupees. That's it. So any deduction you claim under 80C, for PPF, LIC, that sort of thing, or under 80CCC for pension funds, or even your own contribution to NPS under 80CCD1, all of it gets poured into this one single bucket. And once that bucket is full, it's full. Nothing more can go in.
So let's quickly talk about the most famous member of this family, Section 80C. I mean, this section covers a whole bunch of stuff. Life insurance, provident fund, housing loan repayments. But for your exams, ICAI, they love to get tricky with the details. So let's focus on a couple of their absolute favorite trap areas.
First up, the tuition fees trap. Oh man, this is a gold mine for MCQs. You have to remember these 4 conditions, no exceptions. The education must be full-time. The school or college must be in India. It's for a maximum of 2 children. And, this is the big one, pay attention. It only covers the actual tuition fee component, nothing else.
And this slide shows you exactly how ICAI sets you up. They'll give you a fee receipt in the question with all these different components. Your job is to be surgical. You have to ignore the development fees, ignore any donations, ignore the bus fees, and ignore the hostel fees. You can only claim the line item that says tuition fees. This is a classic area to get negative marks, so you've got to be sharp here.
Okay, another super common mistake is with the housing loan deduction under 80C. So yes, the principal repayment part is allowed, that's great. And yes, you can even claim the stamp duty and registration fees you paid. But, and this is a big but, you cannot claim the cost of any renovation or alteration you do after you've received the completion certificate for the house. And remember, no double dipping. If you've already claimed something under Section 24, like the interest on your loan, you can't turn around and try to claim it again here.
All right, we've navigated the 80C traps. Now let's get to the real star of the show, the main character in this whole puzzle, Section 80CCD, which is all about the National Pension System, or NPS. This is where most students get tripped up, and it's because it's not just one simple deduction. It's actually 3 different parts working together.
Let's break this down nice and simple. Part 1 is your own contribution. That's under 80CCD 1B. This one goes inside that 1.5 lakh master bucket we talked about. Got it? Now, Part 2 is a special bonus deduction under 80CCD 1B. This is an extra 50,000 rupees. And then there's Part 3, which is your employer's contribution under 80CCD 2. This is another extra deduction. The whole game is just knowing what goes inside the bucket and what stays outside.
So first, let's look at your own contribution. Under 80CCD1, this is capped at 10% of your salary. And the most important thing to remember here is that this is the amount that gets poured into the big 80CCE master bucket, right alongside your 80C investments. It shares that same 1,50,000 rupee limit.
Now, this number, 50,000 rupees. This number is your secret weapon. This is the key that lets you legally claim more than 1,50,000 in deductions. This is the power of Section 80CCD 1B. Seriously, Section 80CCD 1B is a total game changer. It gives you an exclusive additional deduction of up to 50,000 rupees just for your NPS contribution. And the best part? This amount is completely separate from the 80CCE limit. It has its own private bucket. It is over and above the 1.5 lakh limit. This is the single most critical point that so many students miss. And if that wasn't enough, we have the third part, the money your employer puts into your NPS account. This is also over and above the 1.5 lakh limit.
Now, it does have its own cap based on a percentage of your salary, but the key is that it does not take up any space in that main 80 CCE bucket. So effectively, you've got 3 different pools to draw from. The main 1,50,000 bucket, the special 50,000 NPS bucket, and this employer contribution bucket.
Okay, so now that you're armed with all this knowledge, let's circle all the way back to our original problem. 1,50,000 in PPF, 50,000 in NPS. How do we solve this the right way? The way that's going to get you full marks in the exam.
Here is the correct breakdown. First, that 1,50,000 rupees in PPF comes under Section 80C. Now, what does that do? It completely fills up our Master 80CCE bucket. It's full to the brim. There's 0 space left for the NPS contribution under 80CCD1. But that's totally fine, because we have our secret weapon, Section 80CCD1B. We claim the entire 50,000 rupee NPS contribution under this separate special limit. So you get 150 from the 80CCE bucket plus 50 from the 80CCD1B bucket, giving us a grand total of 2 lakh rupees. See, the final number might be the same, but the logic and the presentation are what the examiner is actually looking for.
So, look, if you take away just one single thing from our chat today, please let it be this. The 1.5 lakh rupee cap under Section 80 CCE is the general rule. But your path to maximizing deductions, to saving more tax, lies in mastering the exceptions. And those powerful exceptions are your secret weapons, Section 80 CCD1B and 80 CCD2.
All right, look at this. An assessee pays $22,000 for his family's medical premium, and on top of that, another $6,000 to the CGHS. So, quick, what's the total deduction? The math seems pretty straightforward, doesn't it?
If your brain immediately went 22 plus 6 equals 28,000, then you've just walked right into a trap that ICAI absolutely loves to set. This is exactly where those easy, crucial marks just disappear. But don't you worry, we are going to pull this trap apart piece by piece.
So let's get to the bottom of this. It's a super common mistake, and it's all about understanding the limits, not just adding up the payments. Yep, we're diving deep into Section 80D. This is one of those sections that looks so simple on the surface, but wow, the details can really trip you up. Our mission today? To turn these little traps into guaranteed marks for you. To really get why that first answer was wrong, we need to build a solid foundation. So let's quickly crack the basic code of Section 80D. It's easier than you think.
Okay, the easiest way to think about Section 80D is to imagine you have 2 separate buckets or baskets for your deductions. The first basket is for you, your spouse, and your dependent kids. The second basket is only for your parents. And hey, it doesn't even matter if they're dependent on you or not. As you can see, the basic limit for each basket is 25,000 rupees. But if the person you're insuring is a senior citizen, that limit doubles to a cool 50,000.
Now hang on, because the definition of a senior citizen here is absolutely key. It's not just about turning 60. The crucial part, and you need to remember this, is resident in India. This is a classic ICAI twist. They'll throw in a non-resident parent's age to trick you into applying the 50,000 rupee limit. So you always have to check for 2 things, age and residency.
All right, now for the main event. Let's break down the specific traps that ICAI loves to set in exams. These are the exact spots where students bleed marks unnecessarily. You've definitely seen this number floating around when you study Section 80D, 5,000 rupees. But what does it actually mean? So, this $5,000 is the max you can claim for what's called a preventive health checkup, or PHC. That's for you, your family, and your parents, all combined. But this is where the confusion really kicks in.
And here it is, the single biggest mistake people make with this 5,000. Students often think it's an extra deduction you get, on top of the 25 or 50,000. That is completely wrong, and it's a guaranteed way to get the answer incorrect. So listen up, this is important. That 5,000 rupee PHC deduction is a sub-limit. It lives inside your main basket limit of 25 or 50,000. It does not, and I'm going to say it again, it does not increase your total deduction. Just think of it like a smaller box inside a bigger box.
Okay, here's another trap that's simple but so deadly, the mode of payment. For your regular health insurance premium, the rule is strict. You have to pay by any mode other than cash. But for that preventive health checkup, you can pay using any mode, and that includes cash. I'm telling you, ICAI loves to mix these up in MCQs, so please lock this difference in your brain right now.
So let's think about a really common situation. What if you have a senior citizen parent, but for whatever reason, they don't have a health insurance policy?
Are you just out of luck? Can you still claim a deduction? The answer is yes, you can. And this is a super important rule. You can claim a deduction for medical expenses you've paid for a resident senior citizen parent, all the way up to 50,000 rupees. But, and this is the big condition, you have to pay attention, this is only if you haven't paid any premium for a health insurance policy for that same parent. It's one or the other. You can't claim both the premium and the medical costs for the same person.
So here we are again. Premium of 22,000, CGHS contribution of 6,000. Now let's apply what we actually know.
Let's see how this looks in a clean working note. We list the premium, 22,000, and the CGHS contribution, 6,000. The total amount paid comes to 28,000. But, and this is the whole point, the maximum limit for this basket is capped at 25,000. So the deduction you can actually claim is 25,000, not 28. That was the trap, and now you know exactly how to avoid it.
Here it is, your master checklist for Section 80D. If you can remember these three things, you're golden. Number 1, the 5,000 for PHC is inside the main limit, not on top of it. 2, premiums are non-cash, but PHC can be cash. And 3, you can claim medical expenses for an uninsured resident senior citizen. Nail these 3 and you've basically mastered 80D. All right, pop quiz for you. Take a look at this. Mr. Sharma, he's 65 years old, and he's earned 60,000 rupees from his fixed deposit interest. So what's the maximum deduction he can claim? Take a second. Think about it. You got an answer in your head?
Ouch. If you were thinking 10,000 rupees, hey, don't sweat it, you're in good company. But you just walked right into a classic ICAI trap. The real answer is so much better. And that 40,000 rupee difference is exactly what we're going to master right now.
You see, the real problem here isn't that these sections are complicated. They're not. It's that they are just similar enough to get you confused under exam pressure. And that's exactly where those easy, precious marks just disappear. So to really nail this down, let's look at a typical exam problem. But hang on, put the calculator down, don't solve it yet. I just want you to look at the next slide and see how the examiner throws all these different ingredients into the mix, specifically to throw you off.
Okay, here it is. Mr. A, he's 61, resident. He's got business income, lottery winnings, some FD interest, and a PPF investment. This is ICAI's signature move. They just unload a bunch of stuff on you to see if you can pick out the right tool for the right job. And the two details that matter most here, his age and the type of interest.
All right, let's build this from the ground up. The first tool in our kit is Section 80 TTA. This is the one most people know, or at least they think they know. But it's the limitations of this section that create the entire trap.
So let's break this down. 80 TTA is for individuals and HUFs. But here's the line that costs marks, the one that trips everyone up. It applies only to interest from a savings account, not FDs, not RDs, just savings. And the limit is a flat 10,000 rupees. Lock that detail in your mind.
Okay, now for the upgrade. This is the section that is an absolute game changer for senior citizens. Section 80 TTB. And this isn't just a minor tweak, it is a completely separate and way more powerful provision.
And wow, just look at the difference here. First, 80 TTB is exclusively for resident senior citizens. That word resident is key. Now, look at the income it covers, both savings accounts and fixed deposits. That is huge. And the limit? A massive 50,000 rupees. We're talking 5 times more powerful than 80 TTA.
This slide right here, this is your golden ticket for MCQs. Seriously, screenshot it, write it down, burn it into your brain. It shows the 3 core differences: who can claim, what income is covered, and the limit. If you know this table, you've won half the battle. And by far the most common trap is what I call the double dip. This is where students, usually in a hurry, try to claim a little something from both sections. It's a tempting mistake, and it's an immediate loss of marks.
Let's be crystal clear on this. The law says it right here. If you're a senior citizen and you are eligible for 80 TBT, you are automatically banned from using 80 TTA. It's one or the other. For a senior citizen, your brain should immediately jump to 80 TTB, and just pretend 80 TTA doesn't even exist.
Now, for the more advanced trap. This is what separates a good answer from a perfect full mark answer. It's all about the overall limit on Chapter VIA deductions, and ICAI absolutely loves to test this in descriptive questions.
So first, you got to remember what special incomes are. You know, things like lottery winnings, certain capital gains. stuff that gets taxed at its own flat special rate. The government is very protective of these. They don't let you use your regular deductions to lower them. So here is the absolute rule you must know. Chapter VIA deductions cannot be claimed against special incomes. So the process is simple. Step 1, calculate your gross total income. Step 2, find any of those special incomes and just pull them right out. Subtract them. The number you're left with, that is your real, hard ceiling for deductions. It's the absolute max you can claim, even if your 80C and 80TTB deductions add up to more.
All right, theory time is over. Let's head back to Mr. A and apply everything we just learned. We're going to solve this problem and get every single mark available.
Let's break this down. Mr. A is 61. He's a senior citizen. So for his $30,000 in FD interest, he gets a deduction under 80TTB. His PPF gives him $150K under 80C. Total deductions seem to be $180,000. But wait, trap number 2. His GTI of $285,000 includes that lottery winning of $120,000. So we have to find our real limit. $285,000 minus the $120,000 lottery income leaves us with $165,000. That's our ceiling. So even though his deductions add up to $180,000, we have to restrict it to $165,000, and that's the key.
If you remember nothing else from this, remember this slide. 80TTA is the basic power. It's for everyone, but only on savings interest, and it's capped at 10K. But 80TTB, that's the superpower. It's only for resident senior citizens, but it covers both savings and FDs, all the way up to 50K. Standard power versus superpower. Simple.
So knowing all the provisions is only half the battle, right? Presenting them correctly to the examiner is the other half. So how do you actually structure your answer in a descriptive question to make sure you get full marks? Let's break it down into a super simple, repeatable framework. To lock in those full marks, just use this 4-step formula every single time. 1. State the provision. Always start by quoting the section number. It shows confidence. 2. Explain the rule. Put it in your own words to show you actually understand it. 3. Apply the facts. This is where you connect the rule to the numbers from the question. And finally, 4. Conclude. Give a clean, clear, final answer. This structure shows the examiner you didn't just guess. You understand the law and how to apply it. So let's bring it all home. If you remember only one single thing from this entire explainer, let it be this. Chapter VIA deductions are a shield that can bring your income all the way down to 0, but they can never be a sword that creates a loss. And the master rule that enforces this, the captain of the ship, is always Section 80A.